In March 2020, oil prices went negative. Not low, negative. Traders were paying people $40 a barrel to take oil off their hands. The commodity that powered the entire 20th century became briefly worthless. Not because we stopped needing it, but because the machinery that moves it, stores it, prices it, and finances it broke. That's what happens when the global economy doesn't just slow down, it seizes up. And the thing that breaks first is never what you expect. Right now, we're watching something similar begin to unfold. Not a sudden collapse, something slower, more distributed. Central banks are pulling back, growth is softening, trade is cooling, and if you know where to look, you can already see the stress fractures forming. But here's what makes this moment different from past slowdowns. The global economy isn't just big, it's interlocked, it's leveraged, it's running on borrowed time, borrowed money, and borrowed confidence. And when confidence wavers, the parts that seemed unbreakable start to crack in strange places. So what actually breaks first? Not the stock market, not unemployment, not even GDP. It's the places where money has to move fast, where trust is assumed, and where everyone thinks someone else is watching. Let's start with the most boring, most critical, most ignored part of the entire system. There's a corner of finance so dull that even bankers don't want to talk about it. It's called short-term funding markets. Every night after you go to sleep, trillions of dollars change hands in these markets. Banks lend to each other, corporations park cash, money market funds shuffle liquidity. It's the plumbing, it's invisible, and it only makes the news when it stops working. Here's why it matters. Most companies don't keep huge piles of cash sitting around. They keep enough to pay next week's bills, maybe next month's. Everything else is invested, tied up in operations, or pledged as collateral. So when they need to make payroll, or pay suppliers, or settle a transaction, they borrow for a day, sometimes just overnight. This happens billions of times every single day. And it works because everyone assumes everyone else is good for it, until they don't. In September 2019, something weird happened. The overnight lending rate in the US suddenly spiked from 2% to 10% in a matter of hours. Banks stopped lending to each other, not because they were broke, but because they weren't sure who else might be. The Federal Reserve had to inject hundreds of billions of dollars into the system just to keep it from freezing. No recession, no crisis, just a momentary loss of confidence. Now, imagine what happens when the economy actually slows. Here's a question most people never ask. How does a sneaker get from a factory in Vietnam to a store in Ohio? Someone has to pay for it multiple times. The factory needs money to buy materials. The shipping company needs money up front. The importer needs credit to place the order. And none of them want to wait 90 days to get paid. So banks step in. They issue something called letters of credit. It's a promise. The bank guarantees payment, and everyone in the chain can keep moving. This is called trade finance, and it's a $70 trillion market that most people have never heard of. Here's the problem. Trade finance is built on two assumptions. One, that goods will keep moving. Two, that everyone will keep getting paid. When the economy slows, both assumptions get tested. Shipping volumes drop. Orders get canceled. Suddenly, the bank is holding a letter of credit for a container of goods that nobody wants, or the importer goes bankrupt before the payment clears, or the factory shuts down because it can't get the raw materials. And because everything is leveraged, one broken link breaks the next. In 2008, trade finance froze, not because of subprime mortgages, but because banks stopped trusting each other. Goods sat in ports, factories idled, the physical economy ground to a halt, even though technically the money was still there. It just wouldn't move. This is what breaks first in a slowdown. Not the big, visible things, the small, essential ones. If you want to know when the global economy is really slowing, don't watch the S&P 500. Watch currency markets in places like Turkey, Argentina, and South Africa. Because when times are good, money doesn't just sit still, it runs. Here's how it works. When times are good, investors chase returns. They pour money into emerging markets, higher interest rates, faster growth. It looks like free money, but that money is almost always borrowed in dollars. A Turkish company takes out a loan in dollars because the interest rate is lower. A Brazilian developer finances a project in dollars. A South African mining company borrows in dollars. Everything is fine until the dollar gets stronger. And when the global economy slows, the dollar always gets stronger. Now, that Turkish company owes more in local currency than it did last year, not because it borrowed more, but because the lira collapsed. Now it can't pay back the loan, so it defaults, and the bank that lent the money takes a loss, and investors start pulling money out of Turkey entirely. This triggers a loop. Currency falls, debt becomes unpayable, capital flees, currency falls more. It's not a crisis yet, but it's a preview. In 2018, this exact scenario played out. The Fed raised rates, the dollar strengthened, emerging market currencies collapsed. Turkey's lira lost 30% of its value in a few months. Argentina's peso went into free fall. No global recession, just a slowdown. Now, imagine what happens when it's not just a slowdown, when it's a full contraction. Let's talk about something that sounds safe but isn't: investment-grade corporate debt. These are bonds issued by big, stable, boring companies, the kind of companies that have been around for decades, the kind that pension funds and insurance companies buy because they're supposed to be reliable. Except there's a problem. A lot of these companies aren't actually that stable anymore. Since 2008, interest rates have been low, so companies borrowed a lot. They borrowed to buy back stock, to pay dividends, to acquire other companies. And because rates were low, nobody cared. But here's the trick. A company is only investment grade because a rating agency says so. And rating agencies are slow to downgrade. They wait. They give companies the benefit of the doubt, right up until they don't. When the economy slows, revenues drop, profit margins shrink. Suddenly, a company that looked rock solid starts to wobble, and the rating agencies start paying attention. If a company gets downgraded from investment grade to junk bonds, something strange happens. All the pension funds and insurance companies that own that debt, they're not allowed to hold junk bonds, so they have to sell, all at once. The price collapses, the company's borrowing costs spike, and now they're in real trouble. This is called a fallen angel, and there are trillions of dollars of corporate debt sitting right on the edge of that downgrade. In 2020, during the first wave of COVID lockdowns, the volume of fallen angels hit a record. Ford, Occidental Petroleum, Macy's, all downgraded in a matter of weeks. The only reason it didn't spiral into a full meltdown was because the Fed stepped in and started buying corporate bonds. But the Fed can't do that forever, and the next time, they might not move fast enough. Now we come to the strangest part of the system. It's called the repo market, short for repurchase agreement, and if you've never heard of it, you're not alone. Here's what it does. Every day, financial institutions need cash, not for investments, just for basic operations, settling trades, meeting regulatory requirements, paying out withdrawals. So they borrow cash overnight, and they use government bonds as collateral. It's supposed to be the safest transaction in finance. You hand over a treasury bond, you get cash, and tomorrow you reverse it. Simple. Except it's not, because the repo market is where all the stress in the financial system shows up first. When banks don't trust each other, they stop lending in the repo market. When hedge funds are over-leveraged, they flood the repo market looking for cash. When the government is issuing too much debt, it soaks up all the collateral. In September 2019, the repo market seized up. Overnight lending rates spiked to 10%. Nobody saw it coming. Why did it happen? Nobody knows for sure. Some say it was treasury issuance, some say it was hedge fund leverage, some say it was just bad timing. But here's the uncomfortable part. It happened when the economy was growing, the unemployment was low, the markets were near record highs. Now, imagine what happens when the economy is actually contracting. Let's zoom out. Since 2008, global debt has doubled. Governments borrowed, corporations borrowed, households borrowed, and all of it was made possible by one thing: low interest rates. But rates